Hi guys, Mortgage Mark. Let's talk about credit scores. How did those random scores show up? Guys, we use in the mortgage industry a FICO scoring model, and just realize that means that on a consumer level, when you guys see credit scores through some credit watch program, it's going to be different than what we have. They're all fundamentally the same. It's just a different grading scale. So just keep that in mind. There's 5 categories of credit, guys. 35% of your score is based on your payment history. Do you or do you not pay your bills on time? That is certainly a big component. What a lot of people don't know is what's known as the debt utilization. That's 30% of your score. So put it this way, if you got a $500 balance on a $500 limit credit card, you are maxed out. That hurts your credit score. That same $500 balance on a $5,000 limit helps you guys. It's a much better score. So that's 30% of your score. So if your scores are lower than what you think and your credit cards are maxed out or above a certain threshold percentage, that may be the quick and easy answer. Just pay down or off some debt. Don't have to be off completely, but down, and you might improve your scores. 15% is the length of time you've had your credit. The longer you have a credit card, the better they're able to see the payment history. Same with mortgages and cars, etc. So don't get if you got a bunch of new credit, you're going to find your scores will drop initially when you get a bunch of new consumer debt. After about 12 months, the score should start going back up, and you build a history of it. The longer you have it, the better. So that's why we tell folks, don't just go cancel a credit card you've had for 7 years because you're not using it. It may be helping your scores. The last 2 components are 10% and 10%. One is just the inquiries. If you go get 7 inquiries from a credit card company, 7 different credit card companies, it will hurt your scores. Mortgages and cars are treated differently, so you don't have to worry about shopping and calling 2 or 3 of us and having us pull your credit. It's not going to hurt you the same way that it would if it were revolving or consumer debt. We're good debt. That's bad debt. The last 10%, guys, is just the actual type of account. Again, good debt, mortgages, cars, but bad debt, credit cards. So it's based on what that is. I've heard the perfect scoring model is 1 car, 1 mortgage, and 3 credit cards. There's no such thing as perfect, but if it were, that's supposedly the model they're looking for. If you guys have questions, especially about, hey, how do I get my credit scores up, or what can we do? We have simulators we can run that say, okay, pretend this does, pay this off, or don't do that, or that late's not here, or this dispute's removed. We can help you work on that, and we know some of the best in the biz at credit rescoring as well if you guys need some help on that. Call us if you need us. We look forward to working with you.